Hey, thank you very much for being on, Larry. Everyone, this is Larry Cheung, CFA charterholder, has a YouTube channel, and we can talk a little bit about what you do in your entrepreneurship too, Larry. But we're going to be talking about the CFA program and how Larry has used some of the information from the program to inform his investing today. And he talks about a lot of those investing strategies on his channel. So, Larry, thanks for being on.
Really glad to be here today. Thanks.
What would you say? I've seen fundamental analysis, technical analysis, some macro strategy. What's your primary focus in investing right now, Larry, or is it all of those things?
I would say that my investment strategy is a combination of all of the things that I express on my channel: fundamentals, macro strategy, and also technicals. But in terms of weighting and how I make my decisions, I would say that fundamentals is most likely around 50 to 60% of my decision making. Macro is around 25 to 30%, and then technicals is that final 10%. I use technical analysis to find entries and exits, okay. But in terms of which names, what sectors, what themes I like, I rely heavily on macro and fundamentals.
I've heard similar rhetoric from some fund managers who aren't a technical strategy. They're not a tactical or a market timing strategy, but many of them will implement technicals for like exactly what you just described, entries and exits. So with your fundamental research, are you typically doing like equity valuations based on cash flow models? How do you think about making investment decisions?
Right. So the way I think about fundamental analysis is I'm much more qualitative, and I don't actually rely that much on valuation and modeling. The CFA program does an incredible job teaching us modeling, DCF models, but then there's that awesome, qualitative aspect of fundamental analysis. And that's what I tend to focus on. I look at, industry prospects. I look at really important metrics like growth rates. And I also look at competitors. I look at moats. But then from there, I select companies that I believe have winning products and winning management teams. So I look at fundamental analysis from the perspective of someone who chooses a company for a winning product, for a winning management team, and they have strong prospects in their industry that have really positive total addressable markets. Mm-hmm. And that's how I go about my fundamental analysis. And because of that, it usually steers me towards a lot of the leaders in the industries. So for example, within tech and consumer discretionary across US and China, most of the names that I personally invest in are large cap, because those are the secular winners. I tend to pick the secular winners. My specialty is not really in small caps or mid caps or companies that are highly, highly cyclical.
I like what you say about, the ways to make fundamental investment decisions. And I tell people that the same thing pretty often, because I commonly get this question, maybe you do too, Larry. Hey, between CFA exams, or sometimes people will say, hey, in addition to studying for the CFA exams, and I always say, no, it's not a great idea. But people will ask me what other advancements or programs or skills should they learn, and a lot of people want to know how to make DCF models in Excel, discounted cash flow models in Excel. Some people want to code Python, and I've shared with people, hey, it's never a bad skill to be able to make a DCF model in Excel, but especially if you're thinking about your own investment decision making, I think it might be more common, or you could argue more successful, to be making more qualitative investment decisions, or focusing more on qualitative factors rather than the quantitative, because like you can make a DCF on Tesla, and I have no idea where you'd go with future projections and or trying to rationalize current valuation with that. Whereas if you go, hey, people are going to be buying electric cars and batteries, and they're dominating the market in that space right now, then there's a better case. And so it seems to me like the market, at least over the past few years, maybe you could say 5 to 10 years, has rewarded the qualitative factors, in some cases more than the quantitative factors. So it's definitely a valuable way to make investment decisions. And it sounds like that's what you're doing.
Exactly. So I know how to do DCF models. I know how to do valuation models. Now, of course, I do look at valuation. I look at earnings multiples. I look at sales multiples, but I look at the high level data. I don't create very complex, extensive models, because what I've found is there is a trade-off between your research time and your actual ability to execute on your ideas. If you spend so much time with the modeling, with these specific assumptions, it's very difficult difficult to have a timely investment strategy when the markets are moving so quickly. So I spend a lot of my time studying the narratives behind companies and studying the narratives behind governmental policies and the Fed, both in the US and in China. And what I found is when I can understand when the narrative and when the story is going to shift, that's when all the pricing is going to be repriced. So I believe I talked about this on my YouTube channel over the last several weeks. And I know that the timing wasn't exactly precise, right? It took several weeks, up to a month, for my ideas to play out. But I discussed this concept where China and their monetary policy is going to diverge from the US. I made that video, I believe, in mid-February. And then it took about a month for the market to actually realize that the monetary policy for China is going to kick in, and therefore the Chinese internet sector would have a very powerful tailwind from there. But spotting that narrative, understanding the implications behind that, that's my specialty. That's what I like to focus on. I don't necessarily like to focus on DCF models or complex models for forecasting, because in a world where things can change so quickly, I think that they're nice to have, but those are not tools that I use extensively in my decision making.
Okay. And thanks for mentioning some of the rhetoric around your thinking on China, your thesis there. We'll talk about that too. Before we get away from the CFA exams, I sort of teed it up in the introduction. Why and how did you choose to pursue the CFA program, Larry?
So when I was at Northeastern University here in Boston, I did several co-ops at one of the big four accounting firms. You may have heard of PwC.
Yeah.
So I worked in their audit, their taxation, and their transactional services segments. And I liked the work, the people were great, but I did want to take the next step in terms of applying accounting knowledge. And that would be a role in financial services. So my first job out of school was an investments analyst position at Sun Life Investment Management. And that's the asset management arm of Sun Life, the insurer. And in order to advance in the company, you were actually encouraged to take the CFA. So it was more by requirement than anything else. So I went through level 1, I went through level 2. Level 3, I had to take twice because it was a very challenging test for me. But I would say the skills and the time that I spent dedicating towards this test, definitely worth it. You don't really realize the value of it until after you finish the process, but the training, the knowledge, the ability to do great analysis, those are things that carry with you upon finishing this program, which takes a couple of years.
Well, I heard you talk in pretty good detail in, excuse me, about your level 3 journey there, failing at once, retaking the exam, in your great YouTube title video of how I went from broke to millionaire. So anyone who wants to get the in-depth story about Larry's level 3 journey, I'll direct you to his channel. Check out that video. I thought it was pretty interesting. A question that I've heard differing answers on now, Larry, is, all right, you've completed the program, and I know you run a business. You also do a lot of investing in your own time. So in that investing that you do now, how much information from the CFA program are you utilizing? How much do you think the program has helped your investment decision-making today?
I would say that the CFA has given me a very strong foundation for what I do. I think a lot of our followers and audience on social media, when they say that they enjoy my research, part of that fundamental training that I have is definitely attributed to the training that I got from the CFA. So I would say it gave me an incredible background in analysis, deeper thinking, and the ability to research things at a degree that retail investors normally don't do. Now, what I also would like to credit the CFA Institute for is they have refreshed membership readings. I don't know if you've heard of that, AJ, but every year they come out with refresher readings for CFA charter holders to understand how the CFA is actually teaching the candidates today in terms of their topic. And so I actually do read the refresher readings. I do read the content that they publish just to make sure that I'm up to date with any institutional frameworks that are widely used by fund managers out there on the buy side. So I would say the CFA Institute and their content has influenced a lot of my decision making. Now, these days, we're in an environment where geopolitical risk and geopolitical, I would say, content is much more important than fundamental analysis, at least in the short term. But what I've always found is that macro events like this are usually short-lived. They influence the market very sensitively for anywhere between 1 and 3 months. But then afterwards, the principles of fundamental analysis play back into the market. So, of course, the CFA Institute does not prepare us to really take full advantage of deep market corrections when there's this level of geopolitical risk, but it does tell us how to approach a structured thought process. It does teach us how to approach finding the best industry during certain parts of the economic cycle. So net, I would say better have it than not.
Mm-hmm. Okay. No, I didn't know that the Institute, I think I've stumbled across a few of those readings, those updates on the CFA Institute's thinking on things. I think I probably have read a few of those, but unknowingly that those were purposefully published for exactly what you just described. And I wish I would have known that a couple of weeks ago, because I was talking to a friend of mine who's a medical doctor, and they have all this required training to stay up on new medical technology and discoveries in the medical field, because that's changing rapidly too. And he said to me, well, because sometimes I'll compare the CFA designation to the medical degree, which it definitely takes much less time than medical school. But, he was like, well, there's no continuing education. That doesn't make a lot of sense. And my response was, well, it's sort of assumed that once you have that charter, you're working in the industry closely enough to investment decision making that you're sort of continuing your education through your work. But the fact that they put those published papers out, focusing on educating folks like yourself and myself, is encouraging, and I think I want to check those out. It's probably just listed on their website somewhere, right?
Definitely. So if you go on the website, you log into your portal, you'll be able to access the member refresher readings. Yeah, and these days they include content on coding. They include content on AI, and they even have digital assets content that cool. was not in the curriculum when I took the exam, but now it is. So, and it's in the refresher readings.
Let's talk about your thesis on China a little bit, Larry. And I heard you talk about this on YouTube shortly after I had sort of, to be transparent, this is an investment recommendation. I had started increasing my own holdings in Chinese equities. And so I saw that, and it gave me the, you'll probably remember the name of this bias, where it's like, oh, hey, I was right. Someone else is doing it, but I really liked what you had to say there. So what's your ideas and thoughts on China right now?
Sure. So just to recap everything that happened last year going into this year, so that your viewers have some context. As you know, last year was a very challenging period of time for the Chinese internet sector. So those are the names such as Alibaba, Tencent, Baidu, Bilibili. And that's because there was a lot of government oversight in order to rectify the kind of business models that had let them essentially become monopolies in the space. So yeah. While a lot of analysts would call this to be market unfriendly policies, the fact of the matter is these regulations are designed to allow smaller businesses and allow competition to actually have a chance to survive in the business climate in China. So I would say that although the policies were unfavorable to Alibaba and Tencent, at least in the near term, longer term, the marketplace becomes a fairer place. The marketplace in China becomes a place where Alibaba and Tencent's growth won't come at the expense of smaller entrepreneurs. And I think that from a stability point of view, that is the right call to make. So I do believe that even though there was shareholder pain for people who held Chinese equities, including myself, yeah, I do think that it sets up China for a stronger foundation for Alibaba and Tencent to have these policies now written black and white, so that there's not that kind of ambiguousness as to what they can or what they can't do. So now that the regulations going into 2022, the regulations are more incremental rather than like large unexpected regulations that we saw last year. I do believe that the multiples that Alibaba, Baidu, and Tencent can command will start to stabilize. I'm not saying they're going to rebound right away. In fact, a lot of my content has discussed that I see this space as in recovery mode. It's in a U-shaped rebound where once we see several more quarters of fundamental positive updates in their business, and we see positive consumer consumption data out of China, and also the real estate sector stabilizing, because that's a very big part of their economy, that's when we start to see these companies start to form a bottom where they don't look back. Now, in terms of the price action in the last several weeks, well, on my YouTube channel, I made this conclusion that Alibaba and the rest of the Chinese internet sector, at some point this year, I just couldn't know when, that monetary policy divergence was going to kickstart a rebound. I just couldn't be sure at what day. I'm a mere mortal, right? I'm a mere mortal. There's no way I could have possibly known exactly when the officials were going to make that decision. But ever since they did, you can look back at my content and you would see that's exactly what I discussed. I talked about how Alibaba would range between 85 and 100. Of course, it pierced below 85, but these are general guides and estimates. So Alibaba did in fact reach that 75 level before skyrocketing back above 100, and now at last I checked it was over 110. So was that the bottom? Was that the capitulation? There's a lot of evidence to suggest that most likely was the bottom. Now, I hate calling bottoms because the moment you say that that's a bottom, the market has a very strong tendency to just, prove you wrong. And then like several weeks after, I look back at my commentary and I'm like, I should have been a little bit more hedged in my language, right? So I don't like calling bottoms, but I do have a higher than average conviction that the changed policy narrative is going to stabilize multiples and stabilize investor confidence. So I would see that any retracement of Alibaba back below 100 is more of a buying opportunity than an opportunity to, for example, get scared. So I know that a lot of people are still very skeptical about the space. After all, there was a lot of pain in this market last year. So a lot of retail investors are scarred from their experience. They're waiting to sell Alibaba at certain resistance levels to cut losses and reduce margin. But I would say that from a structural standpoint, from a fundamental standpoint, if there is monetary easing in China, if there are a softening of restrictions in real estate, and there's an uptick in consumption, the macro direction points more towards a stability and recovery thesis than a further deterioration thesis.
Well, I looked at it and I love the Warren Buffett quote that you should be greedy when others are fearful. And a lot of the rhetoric that you're describing, Larry, is exactly what I saw. I think there was an article, something to the effect of like, Chinese securities, can you ever touch them again? And when I saw that in my head, that was like, wow, I want to buy this right now because this is like one of the worst things you could say about an asset class. And then looking at what were some of the drawdowns on the names you mentioned, I think they were down 60% from the highs.
Absolutely. So Tencent, Alibaba, JD, a lot of these names, they retraced anywhere between 60 and 70% from the highs. Now, I don't necessarily look at the percentage retracement as my overall decision making. That's one aspect of technical analysis. But I would say the way I think about it is this. At some point in the last several weeks, Alibaba was trading around that $70 to $80 price point. And if we look at the share price since IPO, that implies that nearly every shareholder is in the red. So that also implies that because most shareholders, 90%, 95% of shareholders are in the red, that means upon any subsequent bounce, they're likely to try to trim their positions. And there was a lot of short positions in Chinese internet as well. So that was a very defining moment for the Chinese internet sector. And that's why the sector bounced so aggressively because there were so many people shorting it at that price point, and there were also a lot of people waiting to unload at that 100, that 110, that 120 level. But that kind of price action in the market, institutional investors will see that order flow. They're going to see that order flow and pick it up from retail.
Yeah, exactly. That's kind of what I'm thinking, just from a mean reversion standpoint. I looked pretty well into the technology sector there, which you've talked a lot about. You mentioned real estate a couple times. The big headlines here a year ago were
Evergrande.
Evergrande, the big real estate debt burdens that I think I saw infographics at the time were like, well, they had to make a $20 billion payment in February, $30 billion payment in March, and they're not going to be able to meet those obligations. So it just reminded me when you mentioned it. Are they making those payments, or is that creating an issue in the real estate sector still?
So they have made several of their payments, but they are in the process of restructuring some of their debt.
Okay.
And so this is a sector that continues to be closely monitored. I cannot recommend Chinese real estate as an investable sector at the moment until all of the restructuring of the debt has been really processed. I'm much more bullish on Chinese internet because consumption, the internet sector, the total addressable market there, in comparison to the valuation today, there is a mismatch and there is a very strong opportunity. But in terms of like, is there a mismatch between Chinese real estate equities and the total addressable market? I think the Chinese real estate market is discounted for the right reason.
Okay.
So I would not go fishing for deals in that part of this market. I think that's much more risky. There are some situations where we take a high level of risk for a high level of reward. That's the way I see Chinese real estate. I would see Chinese internet as moderate levels of risk at this price point with high levels of reward. Okay.
I want to ask you about, we'll get into your YouTube channel, and then specifically, I'm curious about your inflation video, which has become widely popular. So from one YouTuber to another, congratulations on that. I would love to see a video do something like that on my channel. I think you uploaded that 6 months ago, and now it seems to be becoming ever more relevant. So I didn't watch the video, by the way, and I still want to. What'd you say in the video? Has what you said sort of panned out, and has your investment thesis worked out well for you from that?
Yeah. So in terms of everything that I've said in that video and also my video on stagflation, I rewatched the content actually several weeks ago just to see like my thoughts before this massive tech correction that we got late in 2021, early 2022. And it turned out that a lot of the strategy and the forecast that I discussed played out very well. The problem is, in terms of execution, I didn't expect that to materialize just 2-3 months after I made the video. Sure. So I was not able to trim as much risk as I wanted to. So in my inflation video, in my stagflation video, if you have a chance to watch it, if your audience has a chance to watch it, I talked about several themes. I talked about how the Costco and the Home Depot trade would do very well because these are the companies in the consumer leader segments that have very strong pricing power, and they also are able to really take more market share in an inflationary environment. And because they had that business model intact, Home Depot and Costco have done very well, Costco more so. And I talked about that in the video. I also talked about how this was a period of time when energy is likely to perform a little better than high valuation. Now, unfortunately, because I'm a tech investor and I'm a growth investor, I don't invest in energy. So even though from a thesis standpoint, I verbally said that energy is likely to outperform tech, that's not the way I position my portfolio. Because truth be told, I don't understand energy companies. That's not my area. That's not my specialty. I invest in areas that I feel I understand. So that was, I would say that was a little bit of a learning moment for me where I discussed publicly that energy would likely outperform tech. But my positioning, because I'm just more comfortable with tech, I stayed in technology. And obviously, as you know, that's been a very difficult trade to have, not so much a trade, but as an investment because I'm relatively long-term. So yes. So if you watch those videos.
Yeah. So you may have gotten some comments from folks like, hey, Larry, this was awesome. Thanks so much for the tips. And they may have, done their own research and made some decisions based on you pointing it out, and they might have had a bigger allocation to it anyway than you, who are the
Yeah.
messenger of it.
Right.
Yeah,
So
yeah.
within technology, I focus on high quality tech. I like FANG, I like software, I like semis. Those are the areas and themes that I'm primarily invested in. I just don't have enough visibility into understanding energy. And truth be told, if we want to be really objective about it, a lot of that move up in oil, a lot of that move up in energy, a lot of that is from the Russia-Ukraine crisis.
Yeah.
So oil is what, 110 now? Before this crisis, it was at 90. So we're talking about $20 of the price per oil out of the 110 that was directly attributed to a black swan. So the energy sector and the oil sector are rallying this much. I didn't forecast a war, obviously, when I made my content in late 2020.
Yeah. Yeah.
So
Oh,
I would,
fair.
yeah. So I would say that I stayed in growth. I stayed in tech. Those are the areas that I'm familiar with. And, I ended up being very right in my public content, but in my own portfolio, in my own execution, I wish I was a little bit more diversified, but that's okay, because my forecast going forward, AJ, is that tech will recover, and that leaving tech in the last several weeks, as we can probably see already, was a terminal mistake. So sure. I see tech continuing to recover, and I believe that tech does well in inflation. Probably not as well as energy, but I'm willing to stick to an investment theme that I'm much more of an expert in.
Okay. Yeah, that's fair. You have to invest in what you know in. You have to invest in what you know about, especially when you're making individual selections like that.
Right.
And you talking about these things on YouTube, again, back to that, is doing extremely well for you. I could use some YouTube tips, Larry. Your channel hasn't been around for all that long. It's doing extremely well. Have you ever looked at your Social Blade score? I'm sure it's an A+, just based on views and subscriber growth and all that. What are you doing so well on YouTube, man?
Yeah, so I actually don't use Social Blade. I've heard of it, but I don't use it. One thing that I think would be really awesome for all of my YouTube friends, including you, to really like pay attention to is that the algorithm really puts creators in a certain niche. So for example, you made awesome content on the CFA, and I've made content on investments. And I would say that if you're looking to talk about things broadly outside of your niche, you should do that early on in your channel rather than later.
Yeah.
Because once you become entrenched in your channel, then people will watch your content based on the reason they followed you. So for example, if you made content on CFA strategy, test taking tips, and people followed you there, then people will want to see more of that content. So my content, I've done my best to become as well-rounded as possible. I discuss macro, I discuss fundamentals, I discuss technicals, and a big part of what I like to do on my channel is I like to talk about life as well. I like to talk about philosophy. I like to talk about perspective. I think those are really important elements that add to the sophistication of an investor and an analyst. After all, the famous investors like Warren Buffett, they studied philosophy. They didn't study business. They didn't study finance. They studied philosophy. So one thing that I want to do in the future is continue to make my content well-rounded and continue to make the bulk of my content finance and investments oriented 70, 80%, but leave 20, 25% of my content to really develop a deeper relationship with my viewers. I think that's how you might have first connected with me. You saw my video on the CFA, the non-investment video. So a lot of the times the non-investment videos that I make, those are the videos that really build the trust with my friends on YouTube. Those are the videos that really spark that human connection. Whereas my investments videos, people go there to learn, but it's much more like for a professional reason to understand which stock is better, which opportunity is better, how the economy is doing. So those videos, they're a little bit more transactional, but the non-investments videos, those are the longer term, longer shelf life, and more, I would say, more of a deeper connection with my audience.
I think what you're talking about is exactly true with the YouTube algorithm. And I talked with another friend of mine who does finance videos. his videos on Microsoft Excel tutorials have done exceptionally well. And so we'll look at things because big YouTubers will talk about the click-through rate and the watch duration and all that, and that being a function of how much the YouTube algorithm pushes your video and likes. And in a very, very narrow sense, just him and myself. Now, of course, there's billions and hundreds of billions of views that happen on YouTube, but just for him and myself, we had some videos with higher click-through rates and watch durations that weren't getting a lot of views, meaning the YouTube algorithm wasn't pushing them to a lot of people. But then we'd have videos where I would upload a video on CFA study tips, or he would upload a video on an Microsoft Excel tutorial, just how to use some group of functions in Excel. And then those would get way more views. And I think it's because it's exactly what you just mentioned, Larry. The YouTube algorithm wants you to continue to use things on the same theme as what most people subscribe to you for. That being said, I had one video talk about BlackRock buying a lot of real estate, and there are hundreds of comments in that video about BlackRock being evil, and what I would argue, borderline conspiracy theorists saying that BlackRock's going to take over the world. And so I got a handful, a pretty good amount of subscribers from that. So I think I might need to keep in that direction for a certain portion of my content, even though I'm not nearly as interested in that as CFA exam prep strategies. But yeah, it's interesting to see. I mean, your growth has just been awesome. So I'm going to continue to be a subscriber and listen to what you have to say.
Yeah, well, I'm blessed. I have really, great, friends on YouTube, just like yourself and others watching. And I would say that, every time I make a video on investments, it's a little bit higher pressure because people sometimes follow me into my investment ideas.
Yeah.
And so I now that I've realized that a lot of my audience does that, I need to be especially cautious given the market volatility out there right now. So, I will continue to make content on investments, macro, and stock selection, but at the same time, I will longer term allocate more of my content towards non-investments content, because that's what makes the channel have a larger total addressable market.
Sure.
And in case you didn't know, maybe you do. When the market is not doing so well, to put it lightly, there is a lot of negativity. There's a lot of toxic comments that I see on my channel and other people's channels. When we call for direction, when we make a market call on a specific company or the S&P 500, and the S&P 500 or the Nasdaq's not doing so well, or the sector's not doing so well, there is an incredible amount of negativity, negative comments.
Wow.
So if you take a look at some of my recent videos that I made on the Chinese internet sector, even though I end up being right, long term, even though I end up being right, because in the 2 weeks after I published the video, I was not proven right yet. And there's not, sometimes I would say patience is one of the scarcest resources out there.
Yeah.
And you can see in my comment section that while people are congratulating my opinions today, if you look at the comments that were made, 1 week ago, before Alibaba made this bounce, before the sector made this bounce, you can see how there's a very high level of negativity out there. But that's okay. I welcome all comments on my channel. I welcome constructive, objective feedback. Anytime I see anything that's in disagreement, that's totally fine. Anytime I see anything that's toxic, then I have to take that moment to educate that user, that viewer, that that's not acceptable. But anything that's healthy debate, that's what the market is for. But anytime it gets toxic, that's when I step in and I need to clean up the comment section.
I didn't realize that there was a lot of negativity around something like that. I guess I could imagine there being that, but it's just funny how you talk about Alibaba stock price moving in a different direction in a 5-day period, and now the rhetoric in the comments changed so much. But even negative comments are probably seen as a good thing by the algorithm, I would imagine. Sure. So maybe it's all right.
Yeah. So 2-3 weeks ago, if you look at the comment section in those videos, you'll see things like Alibaba's at 70, Alibaba's going to 50, Alibaba's going to 0. I'll pick it up at 25 cents. And then 2 weeks later, people are saying, Larry, this was a great call. Larry, this was an amazing piece of research. So that's the market, right? And sometimes when I make these types of content pieces, I'm very cautious to just make sure that people benefit from my research, and that's why, you know, down the line, the truth of the matter is, while I will continue to deliver high quality research for my community, I understand that when a recession does come,
Mhm.
which it could come at some point next year. We don't know when. When it does come, the toxic comments are going to come roaring back, and that's
Yeah.
why I want to longer term make my channel to help people in any way that I can, from an investment perspective, from developing an analytical perspective, but also from helping people find success. And that's when the comment section becomes a lot more healthy. So AJ, I would encourage you to make some videos on stock selection. And I hope that the stocks that you cover skyrocket right after from there.
Yeah.
Because I
Yeah.
can promise you, if the stocks that you select tank after you make the video, you're going to know exactly what I'm talking about. But at the end of the day, I welcome all of our friends to comment on my videos. It is a great community. That's how you and I connected together, right? It's just a part of the game. And you might have seen that one of the bigger YouTubers in the space, Chicken Genius Singapore, he's leaving YouTube because he got so much criticism from other YouTubers,
Oh,
and he got so much criticism from the haters. And I'm really sad to see him go. And he made that announcement yesterday in a video. It's gotten about 150K views. The biggest finance YouTubers like Jeremy Financial
yeah.
Education, Larry Jones, and others are already commenting it. They've already made their response videos. So the YouTube drama is real. And so I would just like continue to encourage positive thinking among our listeners watching this video, that at the end of the day, we as YouTubers are here to help you. We are here to provide value. And so we don't want this kind of drama. We want the best for everybody.
Yeah, I totally agree with that. I couldn't even really see myself. Now, I don't have much of a following and I haven't gotten a lot of those types of comments before, but I would not want to get wrapped up in any of that. So it's too bad to hear. Yeah, you're right. But we'll continue to put positivity out there and hopefully good information. Not necessarily ever going to be exactly right in terms of investment recommendations, but it can be.
Absolutely. Yeah. Like it's very, very challenging to know when it's going to play out. Sometimes we could be wrong for a long time before we're instantly proven right. But that's just the name of the game.
Any other comments before we sign off here?
Yeah, I would say, I know your channel viewers are very big on learning about the CFA and the journey there. So I would encourage all of your viewers, whether they're taking the CFA, the CPA, or any other professional challenge that they're putting themselves through, to stick with the course, to stay disciplined, don't give up, have a positive mindset, because at the end of the day, many times things usually work out for the better.
Okay. Yeah, I like it. Well, hey, thanks, man. I appreciate the time. It was good to talk to you on here.
Same. Cheers.